What is going on, everyone? Hopefully y'all are having a good Tuesday and hopefully y'all banked today. But making this video from a recommendation off Instagram and just generally off the Discord, and that's how to use standard deviation to its max. So when finding standard deviation, you want to find the manipulation leg. It's always finding the manipulation leg. Just go ahead and write it down for y'all. And this, I would rather do it on the 1 minute and on the 5 minute, but it's very well possible to do it on the 15 as well. But it's more accurate within the 5. And then the way you would target this, I'm going to show you by drawing, and then I'm going to show you an example by candlesticks. So whenever you do see price, whenever you do see price consolidate within a range, it's always going to stay stuck within 2 levels in bounds. And then whenever you do see a manipulation leg, it would cause a break of structure, kind of. But then that's just us sweeping all of this buy side liquidity that we just generated in the market. It's going to be LR. So once we end up manipulating out, we probably hit some sort of PD array or just sweep liquidity in general, and that's whenever we manipulate. So whenever we manipulate, we end up causing a distribution leg, taking the rest of all those sell stops, and then from there we would just take down the standard deviation of this leg right here, the one that caused the change in that direction. So not to change the state of delivery, but this could be a wick or this could be candles via candles closures, but just us, as long as we manipulate out, take some sort of buy side liquidity here, and to be able to enter a distribution model. So pretty much we get the standard deviation of this leg that I highlighted, and then from there we would target these ranges. So these could be take profit ranges or ranges where you could just bottom tick and top tick. So once you enter your position, say you enter right here off of fair value gap, inverse fair value gap in CISD, you would just target the -2 deviation, and or you could target the -4. But this is how you use standard deviation on just hindsight. And if I'll show you a bearish play, it is the same thing, but just looks this looks the same way, just invertedly. So here we have consolidation. We take out stops here and manipulate down, and we end up taking liquidity or tapping into a imbalance PD array or anything of that sort. Tap into it, then we get our inverse fair value gap or CISD, and then we aim in for our standard deviations. And usually with these standard deviations, you really want to look out for the -2 and the -2.5 for a retracement zone or a top tick. But if you don't get it, then the zone with the most impact would be your -3.5 and 3 and 4. So pretty much -3 and 4 is a big box, -3.5 being the CE of it, but you just want to find a retracement within this zone here. And if there's overlapping PD arrays, even better. But now let's take it to an example within the chart. So I'm going to be using the 5 minute here. I'm going to clear all these indicators. So here we spot consolidation, and then we manipulate out. So we want to use this as our manipulation leg. So we get the standard deviation from the bottom to the top of the cause of the standard deviation, and here a -1, we were able to top tick there. But here if we wanted to take longs, we could have just used it as take profits as well, but we definitely would have had a stop loss hit, or if we had a stop down here, we would have still won the trade. But just using the same, this is inverted. That is my fault. It is still inverted. And then here we have the manipulation, and I just got a bearish play. Now this is a bearish play as well. I just got a bullish one that was inverted, But here we end up consolidating, we manipulate out, so we take standard deviation, and then -1 hits pretty good, all the way back to to these highs up here. And we were able to get that as a trade. That's how I use standard deviation. And then you could have used standard deviation here again with this sideways accumulation and how we manipulate out from here, this zone to this zone. And that would be your manipulation leg, since we do consolidate here. And then we do manipulate out a little bit, but we continue again doing a small consolidation accumulation phase here, and then we manipulate out to take out liquidity, and then that gives us standard deviation ranges as well. And that hits the -4 just right at the tick. And then if we top that with PD arrays, it's even better. So like here I do see a BPR, and then we tap CE into the CE of it, and -4 does line into it as well. So that could have been a bottom tick for you. And that's how, just a little brief overview of how I use standard deviation. It's always going to be in the manipulating leg. So you would want to just typically look for AMD, and keeping the same model from the Discord and the way everybody's been kind of relearning all this, the traditional AMD. And then later on we're able to switch from traditional AMD to top taking and bottom taking with standard deviation, and using the Z-star model that's in the Discord. But that's, in retro hindsight, that's how it is, how to use standard deviation. Again, here we have a lot of consolidation. We consolidate, manipulate out, so we could end up using that as a target. So here again, -2.5, we tap into it, bottom tick, target opposing liquidity. And that's what we do. And then same thing again with this leg here. You could use them backwards as well. You could dev stack. So if you want to use this manipulating leg, you could just go ahead and use it the same way as here. And at this one we tap into the -3 and being able to top tick that way as well. So you could use them both sides, and that way you can have more levels. So if you wanted to, you could just mark out ranges with a horizontal ray, and then keep those as like key, I guess like key lines to look at, or just key levels in general to have, and you're able to top tick right there as well. It's just spotting nothing but just traditional AMD, wherever we accumulate and then manipulate out to. That would be our PD array. So here we have sideways accumulation. We do manipulate up and distribute down. So we would take that manipulation leg that we do end up taking from here to here. Then, sorry, my bad, it should have been this one. And then again, we don't get the -2 hit, but if you want to, you could, depending on where you find your manipulation, you're able to find your bottom tick as well. And this is using the 15-minute and showing you that you could use the 15-minute as well, but at the same time everything would just translate to the 5-minute perfectly. It would just be a bigger range. So here we have sideways accumulation, we manipulate out, and you could just always tell if we're going to manipulate out and if there's a following distribution leg. So we manipulate out here, taking liquidity, and we have a distribution model within this leg here. So same thing here, we have a lot of accumulation, we manipulate out, so you would take this whole leg here and take the standard deviation of it. Actually, that one's one too high. So right here, necessarily we don't tap into it, but like I was saying, these boxes kind of like matter, and they're like kind of like a play out like a fair value gap or order block. So that's how you can be able to use them. But that's how I'm able to top tick and bottom tick, or at least have more ranges and key levels within the market. And I tie them up with a lot of high time frame PD arrays, especially on the 1 hour and on the 15-minute. And then from there, I end up going about my trade. So like here, we had a perfect setup on the 5-minute manipulation leg. We had a -4 deviation that ended up going into a 15-minute BPR, and we were able to bottom tick using the CE and that -4 deviation. that's pretty much it, and how I use standard deviations and how you could use them to be successful in the market as well.